The West does not fear Islam's prayers. It does not fear the fasting, the pilgrimage, or the daily rituals of 1.8 billion people. What keeps central bankers awake in London, New York, and Frankfurt is something far more threatening. Mathematics, a different equation for money itself. You were taught this conflict centers on religion, on culture, towards scripture, and away from spreadsheets. The real battle has always been about who controls the machinery of money creation. It has always been about whether debt compounds in the hands of lenders or whether risk distributes across the entire economic system. Two models exist. One concentrates wealth upward through the extraction of interest. The other forces capital to share both profit and loss with the people who do the actual work. The Western financial system does not compete with Islamic economic principles. It is structurally incompatible with them. The two models create opposite incentive structures. They produce opposite flows of wealth. They concentrate power in opposite directions. One system makes bankers into gatekeepers who collect rent on money itself. The other makes financiers into partners who succeed only when their investments succeed. This is not about faith. This is about leverage, about who controls the bottlenecks of global finance, about the infrastructure of extraction built over 5 centuries, and the existential threat posed by any alternative. Welcome to Noob Historian. Behind every headline in your history book, there's a ledger they kept hidden. We open it. The reason this matters to your life in 2025 is direct and measurable. Every dollar in your wallet came into existence as debt. Someone borrowed it from a bank. Interest accrues on it from the moment of creation. You work to pay back money designed to grow faster than the economy, producing goods and services. This is not a natural law. This is an engineered system. And 1.8 billion people follow an economic tradition built on the opposite premise. The coming collision between these systems will reshape global finance within your lifetime. The dollar's dominance, your mortgage rates, your retirement account, your government's debt ceiling. All of it connects to a 1,400-year-old prohibition on interest and the modern institutions trying to enforce it. The Western financial system operates on a single foundational premise. Money itself generates money through the passage of time. You deposit $100. The bank lends $90 to someone else. Interest accrues. The bank owes you money. The borrower owes the bank more money. The total claims on money now exceed the total money in existence. This gap between money and claims on money is the engine of the entire system. It requires constant growth. It requires inflation to make old debts payable in cheaper dollars. It requires new borrowers to pay the interest owed to old depositors. Stop the growth and the mathematics collapse. Islamic finance operates on a prohibition called riba. Translated imprecisely as usury, riba encompasses any guaranteed return on loaned money disconnected from productive activity. The prohibition is absolute. It appears in the Quran with language reserved for the most severe warnings. Those who consume riba will stand on the day of judgment like those driven to madness by Satan's touch. For 14 centuries, Muslim scholars, merchants, and rulers built financial systems without compound interest. They created instruments for trade finance, real estate development, infrastructure construction, and international commerce, all without the core mechanism Western finance considers indispensable. The mudaraba contract provides capital from an investor to an entrepreneur. Profits split according to pre-agreed ratios. Losses fall entirely on the investor's capital. The entrepreneur loses only labor and time. This forces the financier to evaluate projects carefully. Poor judgment destroys the financier's money, not the entrepreneur's future. The musharaka contract creates partnership between financier and entrepreneur. Both contribute capital. Both share profits and losses according to their contribution. Neither party extracts guaranteed returns regardless of business performance. The murabaha contract finances purchases without interest. A bank buys a house, a car, or equipment. The bank sells it to you at a marked up price payable in installments. The markup reflects the bank's cost of capital and profit margin. It fixes at purchase. It does not compound over time. These are not theoretical concepts. The Islamic Financial Services Board documents over 1,500 institutions across 75 countries operating on these principles. Assets under management exceed $2.8 trillion. Growth rates outpace conventional banking in most regions where both systems operate. The structural difference creates opposite effects on inequality. In compound interest systems, money flows from borrowers to lenders continuously. Those with capital extract value from those without it, regardless of whether investments succeed or fail. The lender profits from a failed restaurant the same as a successful one. The borrower bears all the loss. In profit-loss sharing systems, financiers absorb failure. They profit only from success. This creates pressure to fund productive ventures rather than extractive ones. It creates alignment between capital and labor rather than opposition. The World Bank study by Beck, Demirguch-Kunt, and Marouche, documented in 2013, found Islamic banks held 33% more liquid assets than conventional competitors. They maintained higher capital ratios. They took fewer speculative positions. The mathematics of profit-loss sharing demanded these behaviors. The mathematics of interest extraction did not. The Western world once operated under the same prohibition. For over 1,000 years, Christianity banned usury with language as severe as Islamic scripture. The Council of Nicaea in 325 AD forbade clergy from lending at interest. The Second Lateran Council in 1139 denied Christian burial to unrepentant usurers. The Council of Vienne in 1311 declared anyone claiming usury was not sinful to be a heretic worthy of inquisition. Thomas Aquinas, the most influential philosopher in Catholic history, wrote extensively against interest. Money is consumed in use, he argued. Charging for both the money and the use of money charges twice for the same thing. This is unjust by nature. European commerce for centuries operated on profit-sharing arrangements similar to Islamic finance. The Commenda contract in Italian city-states mirrored the mudaraba. An investor provided capital. A traveling merchant provided labor and expertise. Profits divided. Losses fell on capital. This funded the Mediterranean trade that built Venice, Genoa, and Florence. The transition happened gradually between 1100 and 1600 AD. It required theological creativity and political pressure. The distinction between usury and interest became a semantic tool. Small returns became acceptable, then moderate returns, then whatever the market would bear. John Calvin in the 1540s provided Protestant theological cover. He reinterpreted biblical passages to allow moderate interest. This was not accidental. Geneva's commercial class needed access to capital. Calvin gave them religious permission. The Bank of Amsterdam in 1609 and the Bank of England in 1694 institutionalized interest-based lending at the core of Protestant financial power. The same nations building colonial empires needed mechanisms to fund armies, navies, and trading companies. Interest-bearing debt provided this mechanism. The theological prohibition died in service of imperial expansion. The Islamic world watched this transformation. It chose differently. The Ottoman Empire, ruling much of the Muslim world until 1922, maintained the riba prohibition formally. Waqf foundations provided charitable lending. Trading partnerships funded commerce. Alternative instruments filled the functions served by interest in Europe. This created a growing divergence in financial architecture. By 1800, European banking had developed central banks, bond markets, stock exchanges, and fractional reserve lending. The Islamic world maintained older structures. This divergence would become a vulnerability when European powers arrived with guns. Between 1800 and 1950, European colonial powers conquered most of the Muslim world. They brought not only military occupation, but financial occupation. The India Office records from British administration document systematic suppression of Islamic financial mechanisms across the subcontinent. The British required Indian merchants to access capital through British-owned banks operating on interest. They dismantled the indigenous Hawala networks carrying trade finance across Asia for centuries. They imposed legal frameworks recognizing only interest-bearing contracts as enforceable. French Algeria's banking documents reveal similar policies. The Colonial administration required adoption of French banking law. This meant interest-based lending became the only legal form of finance. Those refusing on religious grounds found themselves excluded from formal commerce. The Dutch East Indies applied comparable approaches across Indonesia. The largest Muslim majority country on earth had its financial system restructured entirely to serve colonial extraction. This was not cultural imperialism by accident. It served structural economic purposes. Colonial powers needed to integrate conquered economies into London, Paris, and Amsterdam capital markets. This required compatible financial instruments. Interest-bearing debt denominated in colonial currencies tied colonized peoples to European financial centers. The mechanics worked as follows. A railway needed construction in India. British investors bought bonds paying interest. Indian taxpayers repaid those bonds through colonial administration. Wealth flowed from Indian labor to British capital. The interest mechanism ensured this flow continued regardless of whether the railway operated profitably. Islamic finance prohibitions threatened this extraction machinery. If Indian merchants could access capital through profit sharing instead of interest, they might fund their own enterprises. They might compete with British firms. They might retain wealth locally instead of remitting it to London. Colonial administrators understood this threat explicitly. Internal correspondence from the India office discusses the necessity of commercial integration with British banking. The suppression of alternative financial structures appears as deliberate policy rather than accidental displacement. Independence movements across the Muslim world included financial independence as a goal. Pakistani founder Muhammad Ali Jinnah spoke explicitly about establishing an economic system compatible with Islamic principles. Egyptian nationalists targeted British financial control alongside military occupation, but independence came with a trap. The post-colonial financial architecture remained integrated with Western capital markets. The International Monetary Fund, founded in 1944, required member states to maintain monetary policies compatible with the Bretton Woods system. The system operated entirely on interest-based mechanisms. New nations faced a choice: exclude themselves from international trade and finance, or integrate with systems their religious traditions prohibited. Most chose pragmatic integration while promising future Islamization of their economies. The modern Islamic finance movement traces to a single experiment. In 1963, Egyptian economist Ahmad el-Najjar established the Mit-Gummer Savings Bank in a rural town in the Nile Delta. Operating on profit-sharing principles, the bank served farmers and small merchants excluded from conventional banking. El-Najjar designed the institution to prove viability. Depositors received returns based on the bank's investment profits rather than guaranteed interest. Borrowers accessed capital through purchase financing and profit-sharing arrangements. No interest changed hands. The bank grew. Within 4 years, it served over 1 million customers. The Egyptian government, under Gamal Abdel Nasser, shut it down in 1967. Official explanations cited regulatory concerns. The deeper issue was threatening. A functional alternative to state-controlled banking challenged governmental monetary authority. But the proof of concept survived. El-Najjar's experiment demonstrated Islamic finance could operate at scale in the modern world. The 1970s transformed theory into infrastructure. The Organization of Islamic Cooperation established the Islamic Development Bank in 1975. Headquartered in Jeddah, the IDB provided an international institution operating outside Western financial control. The first international conference on Islamic economics in Mecca in 1976 brought scholars, bankers, and policymakers together. The founding documents from this conference established the intellectual framework still guiding Islamic finance today. Participants included representatives from central banks, universities, and religious institutions across 40 countries. Pakistan, as Council of Islamic Ideology, issued comprehensive banking recommendations between 1977 and 1980. These documents detailed mechanisms for converting the entire Pakistani financial system to Islamic principles. Full implementation never occurred, but the theoretical work provided templates for institutions worldwide. Malaysia established Bank Islam Malaysia Berhad in 1983 with government support. Unlike the underground Emmett-Gummer experiment, this was official policy. The Malaysian government deliberately cultivated Islamic finance as a competitive advantage. Today, Malaysia hosts the largest Islamic banking sector relative to GDP outside the Persian Gulf. The Gulf states moved more slowly but with greater resources. Saudi Arabia, the UAE, Bahrain, and Qatar developed Islamic financial institutions throughout the 1980s and 1990s. Oil wealth provided capital. Religious legitimacy from hosting Islam's holiest sites provided authority. By 2000, the Islamic finance sector had grown from nothing to several $100 billion in assets. By 2024, the sector exceeded $2.8 trillion. Growth rates consistently outpaced conventional banking. This growth triggered Western attention. The system was no longer ignorable. The global financial crisis provided an unplanned experiment. Two systems faced the same shock. Their responses differed systematically. The conventional financial system nearly collapsed. Lehman Brothers declared bankruptcy. AIG required a $180 billion government rescue. The entire Western banking system needed over $10 trillion in bailouts, guarantees, and central bank interventions. The cause traced directly to interest-based instruments, mortgage-backed securities, bundled housing loans paying interest. Collateralized debt obligations repackaged those securities into new interest-bearing instruments. Credit default swaps provided insurance on those instruments. Each layer of complexity served to obscure risk while preserving interest payments. The structure allowed originators to collect fees while passing risk to distant investors. When housing prices fell, the mathematics reversed. Losses cascaded through interconnected balance sheets. Islamic financial institutions faced the same falling asset prices. Real estate markets in the Gulf dropped alongside Miami and Las Vegas, but the response differed. The IMF study by Chihak and Hessa analyzed data from 77 countries between 1993 and 2004, with follow-up work extending through the crisis. Their findings showed Islamic banks demonstrated stronger resilience on average during the global financial crisis. The structural reasons were clear. Islamic banks held 33% more liquid assets than conventional competitors. They maintained higher capital adequacy ratios. They took fewer speculative positions. More fundamentally, the absence of interest-based instruments prevented the layering of risk observable in conventional finance. A profit-sharing investment either succeeded or failed. It did not become raw material for complex derivatives disconnected from underlying value. Not all Islamic financial institutions performed identically. Some had drifted toward conventional practices, despite Islamic labels. The investment Dar in Kuwait failed after heavy real estate speculation. Gulf Finance House faced difficulties from aggressive expansion, but aggregate data supported the thesis. Islamic finance demonstrated greater stability during systemic stress. Western regulators noticed. The Bank of England began publishing policy papers on Islamic finance integration in 2014. The European Central Bank commissioned studies on profit-loss sharing mechanisms. The Federal Reserve Research Division produced internal reports on Sharia-compliant monetary instruments. This was not religious accommodation. This was risk management. Central bankers sought to understand why one system nearly collapsed while another survived intact. The answer threatened the entire Western financial architecture. Profit-loss sharing aligned incentives between financiers and real economic activity. Interest extraction did not. Remove guaranteed returns, and financiers must evaluate projects carefully or lose their capital. Add guaranteed returns, and financiers need only ensure borrowers possess collateral to seize. Understanding Western fear requires understanding the petrodollar system and how it captured Islamic economies despite religious prohibition. In 1974, Henry Kissinger negotiated a secret agreement with Saudi Arabia. The kingdom would price all oil sales in U.S. dollars. It would invest surplus oil revenues in U.S. Treasury securities. In exchange, the United States would guarantee Saudi security. This arrangement transformed global finance. Every nation importing oil needed to acquire dollars first. This demand for dollars allowed the United States to run trade deficits without currency collapse. It allowed the Federal Reserve to print money without triggering hyperinflation. The petrodollar system locked Islamic oil producers into Western financial architecture. Saudi oil revenues flowed to U.S. Treasury bonds paying interest. Those interest payments violated Islamic principles. Yet the alternative meant confronting American military power. The kingdom resolved this contradiction through legal fiction. Saudi Arabian Monetary Authority, the central bank, held treasury securities. The government officially earned returns, permissible under necessity doctrine. Individual Saudis seeking religious compliance could use Islamic banks for personal finance. This arrangement concentrated trillions of dollars in Western financial centers. It funded American deficits. It supported dollar hegemony. It prevented Islamic economies from building independent financial infrastructure. The trap operated as follows. Oil revenues arrived in dollars. Investing those dollars required dollar-denominated instruments. The largest and most liquid dollar instruments were U.S. Treasury securities. Interest-bearing by definition, these securities pulled Islamic capital into the Western financial system regardless of religious preference. Breaking this trap required two things: alternative currencies for oil pricing and alternative investments for oil revenues. Both threatened American strategic interests directly. This explains reactions to any movement toward de-dollarization. When Saddam Hussein announced oil sales in euros in 2000, invasion followed in 2003. When Muammar Gaddafi proposed a gold-backed African currency in 2011, NATO intervention followed within months. The pattern does not prove causation. Other factors contributed to these conflicts, but the consistent response to currency independence suggests financial architecture operates as a red line for American foreign policy. The current moment represents acceleration. Multiple forces converge against dollar hegemony. Islamic finance provides both an alternative model and religious motivation for pursuing it. Reuters documented in March 2023 ongoing Saudi discussions with China regarding yuan-denominated oil sales. The Wall Street Journal confirmed similar conversations. The Saudi finance minister denied imminent changes while acknowledging diversification discussions. This represents a potential break in the petrodollar system. If Saudi Arabia prices any oil in currencies other than dollars, the exclusive relationship ends. Other producers gain permission to follow. The BRICS expansion announced in Johannesburg in August 2023 added Saudi Arabia, the UAE, Iran, and Egypt to the bloc. 4 Muslim-majority nations with combined GDP exceeding $3 trillion joined an organization explicitly discussing alternative payment systems. The January 2024 BRICS expansion implementation brought these economies into regular coordination. Finance ministers meet. The infrastructure for dollar alternatives develops incrementally. IMF data documents declining dollar reserves. Central banks globally held 72% of reserves in dollars in 2000. By 2023, this figure dropped to 59%. A 13 percentage point decline over 2 decades represents the largest shift in reserve composition since Bretton Woods. The destinations for departing reserves include gold, yuan, euros, and increasingly diversified baskets. Islamic nations participate disproportionately in this shift. Religious compatibility with alternatives provides additional motivation beyond economic calculation. Cryptocurrency offers another convergence point. The technology emerged from Western cypherpunk movements with no connection to Islamic thought. Yet scholars identified compatibility rapidly. Bitcoin involves no interest. Ownership transfers directly without lending. Ethereum and other platforms enable smart contracts enforcing profit-sharing arrangements automatically. The technology provides infrastructure for Islamic finance at global scale without requiring Western banking cooperation. Sharia-compliant cryptocurrency guidelines emerged from major scholarly bodies by 2018. These frameworks distinguish between acceptable and prohibited tokens based on underlying structures. Mining, holding, and trading meet approval. Interest-bearing staking and certain DeFi protocols do not. This creates a technological pathway around Western financial control. Muslims seeking religious compliance can hold wealth and conduct transactions outside the dollar system entirely. The infrastructure exists, adoption grows. Conclusion: the structural threat. The Western financial system does not fear Islamic prayer. It fears Islamic mathematics. Compound interest creates a world where money flows from workers to owners automatically, where debt grows faster than wages, where productive economies serve debt service rather than human needs. Profit-loss sharing creates a different world, one where capital must align with productive activity, where financiers absorb failure instead of passing it to borrowers, where wealth concentration faces structural barriers rather than structural accelerants. These two systems compete for the future of global finance. One has dominated for 5 centuries through military superiority and institutional control. The other represents 1.8 billion people with growing economic weight and increasing alternatives to dollar dependence. The evidence shows Islamic finance survived the 2008 crisis better than conventional banking. The evidence shows de-dollarization accelerating among Islamic nations. The evidence shows technological alternatives bypassing traditional banking infrastructure. Western policymakers understand this threat. They commission studies. They develop accommodation strategies. They fund integration research. But accommodation changes the Western system. If European banks offer profit-sharing mortgages, they accept Islamic finance principles. If American regulators approve Sharia-compliant instruments, they legitimate alternatives to interest. The competition is structural. It cannot resolve through tolerance or cultural sensitivity. Two mathematical systems producing opposite wealth distributions cannot coexist indefinitely at global scale. The outcome remains uncertain, but the stakes are clear. Your mortgage, your savings, your currency, your government's debt, all connect to which mathematical model prevails. The next time you hear about Islamic extremism, religious conflict, or civilizational clash, ask a different question. Ask who benefits from directing attention toward theology and away from finance. Ask why the money mathematics of 1.8 billion people receives less attention than their prayer schedules. The answer will tell you what the West truly fears.